While there are many famous investors in Japan, there is only one undisputed god of the Japanese investing scene. His name is Takashi Kotegawa, but the financial world know him simply as B.N.F. He is the man who turned a university student's savings of roughly 1.6 million yen into a fortune exceeding 20 billion yen or $181 million in less than a decade. He is the man who managed to make over 2 billion yen in 10 minutes during the most infamous trading mistake in Tokyo Stock Exchange history. He's the man who bought a commercial building in Akihabara with cash simply because he had run out of things to buy for his money. And this is the video about his story. Kotegawa grants almost no interviews. He has no social media presence. He does not sell courses. He really does not want your money. He only wants to trade. To understand his life since he went silent in 2020, I've compiled all the available traces of his career. Old 2chan forum posts, his few media appearances from 2006, public tax records, and the analysis of the Japanese trading community. So without further ado, I am proud to present to you the story of the greatest trader in Japanese history. Part 1. The Death of the Salaryman. For you to understand Takashi Kotegawa, I must first paint a picture of the Japan that he emerged from. You see, the year was 2000, and the world's biggest bubble had burst over 10 years before, and the Nikkei 225, the biggest stock index in Japan, was a graveyard for optimism. The great Japanese dream of the salaryman, a stable, respectable career with lifetime employment that had underpinned the social contract in Japan since 1945, was slowly dying, and the Japanese economy was slowly sinking into an ever deeper recession. This is what we now know as the lost decades. And for the generation coming of age in the late 1990s, the corporate ladder looked less like a path to security and more like a trap. These people had been disillusioned by the Japanese society they saw. They saw their fathers who had sacrificed their life for their corporations now being let go, and many of them looked for an escape. But this was also the time of the IT bubble. In 1999, the whole financial system opened up to regular people. Before this moment, trading stocks was a rich man's game in Japan. It was gated by high fees and only telephone orders. You had to know a broker, and you had to pay a significant percentage of the stock you wanted to buy just to purchase it. It was slow, it was inefficient, and it was very exclusive. Basically overnight, online stockbrokers like Matsui Securities, Rakuten Securities or E-Trade popped up, and they offered low latency and crucially low commissions on stock trades. It was the dawn of the net trader. Thousands of young men retreated into their bedrooms. They armed themselves with PCs and high-speed internet connections. They were the first generation to see the stock market not as a mechanism for capital allocation, but as a massive multiplayer online game played for with real money. Takashi Kotegawa was one of them. Part 2. The Birth of B.N.F. Takashi Kotegawa was born on March 5th, 1978 in Ishikawa in Chiba, right next to Tokyo. His background is aggressively ordinary, and this is important. No math prodigy from a prestigious university, no heir of a financial empire. He was a student at Nihon University, an average university at best, enrolled in the faculty of law. And in a parallel universe, Kotegawa graduates, he passes the bar, he becomes a salaryman lawyer, he works 14-hour days for a steady paycheck, and he retires at 65. In this universe, he found the stock market. The year was 2000. Kotegawa was 21 years old, and he had saved approximately 1.6 million yen, or roughly $13,000 at the time, from working part-time jobs during his studies. Hooked by the relentless ad campaigns of the new internet trading era, Kotegawa entered the market just as a historic downturn began. The US.com bubble had just burst, and it evaporated trillions of dollars in wealth, creating a global contagion that dragged the Japanese stock market down to levels not seen in 20 years. While panic selling turned the markets into a slaughterhouse, Kotegawa quietly opened his account. Needing a handle for the internet forums where traders gathered to share ideas, he chose B.N.F. It was actually a phonetic error. He intended to use V.N.F, honoring Victor Niederhofen, but because the Japanese language treats V and B the same, he misspelled and it stuck. Niederhofer was a very successful trader and George Soros partner, but his edge was purely statistical. He believed that markets followed strict statistical rules, specifically that if an asset price deviated too far from the average, it was mathematically bound to snap back. This approach made him one of the most successful fund managers on Wall Street. But in 1997, the math stopped working. Niederhofen had made a huge bet that the Thai market had fallen too far and had to rebound, but it didn't. In a single day, his fund was wiped out. He lost $130 million and was eventually forced to auction his personal art collection just to not go bankrupt. So why would this young student name himself after a man who lost it all? Well, I believe that Kotegawa saw the distinction between the method and the execution. He adopted Niederhofer's core philosophy, buying the panic dip because the math say it must bounce, but he treated the 1997 crash as the ultimate lesson in risk management. Do not trade on borrowed money. By the time his graduation approached in 2001, the 1.6 million yen he had scraped together from years of part-time work had ballooned into 61 million yen. That represents a 3,712% portfolio growth in just a single year. He calculated that the opportunity cost of finishing school was simply too high. Every hour in law lectures was costing him millions. So, with only a few credits remaining, he decided to drop out. Part 3. The Art of Catching Falling Knives. I have analyzed hundreds of trading strategies, and most of them are absolute nonsense. They are rigged to look perfect on past data just to hook gullible subscribers. But Kotegawa's strategy is different. It is brutally simple, but it is also psychologically impossible for 99% of people to execute. Kotegawa made his initial fortune between 2000 and 2004, and these were dark years for Japanese stocks. The Nikkei 225 lost almost 60%. In times like this, most investors try to pick bottoms based on hope. They buy a stock because it has fallen 50% and they think it cannot go any lower, right? It usually goes lower. Kotegawa inverted this logic. He did not buy because he liked the company. He bought because the selling was emotional. He waited for the selling to reach a mathematical breaking point, the point when the stock was simply too cheap compared to its average, and then he would buy. But the genius of this strategy wasn't the entry. Any fool can buy at a crash. The genius was the exit. As soon as the stock bounced, often just 2 or 3%, he sold. He repeated these small wins thousands and thousands of times. And by the end of 2004, he had made his first billion yen, or roughly $10 million at the time. Part 4. How to make $2 billion in 10 minutes. Every superhero has an origin story. Every trader has a defining trade. For George Soros, that was breaking the Bank of England. For Takashi Kotegawa, it was the Mizuho fat finger error of December 8, 2005. This event is the reason I am talking about Kotegawa today. It is the moment where he transcended from a successful day trader to a national legend. The error. On December 8, 2005, jcom.co, a recruitment service company, was listing on the small cap board on the Tokyo Stock Exchange. It was supposed to be a routine IPO. At 9:27 a.m., a trader at the bank Mizuho Securities received an order from a client to sell one share of JCOM for 610,000 yen. The trader made a typo. he entered an order to sell 610,000 shares for 1 yen each. The computer system at the Tokyo Stock Exchange did not catch the error. The order went live. To put this into perspective, JCOM only had 14,500 outstanding shares in total. Mizuho had just offered to sell 42 times the entire existence of the company for less than 1 penny per share. The stock price collapsed instantly. Most traders stared at their screens in confusion. Was this a system glitch? Was the company bankrupt? Fear paralyzed the market. One person did not freeze. Kotegawa. He saw the anomaly. He did not know why it was happening, but he knew the math was impossible. He knew that 610,000 shares could not exist. He bought 7,100 shares. Now remember, there were only 14,500 shares in existence. Kotegawa had just purchased nearly half of the company's float in a matter of seconds. Other sharks began to circle. The famous Japanese day trader CIS, Kotegawa's friend and rival, also bought, securing about 3,300 shares. Between them, these two kids in their bedrooms now own the majority of a newly listed public company. But then, Mizuho Securities realized the error. Panic ensued on the trading floor. They tried to cancel the order, but the Tokyo Stock Exchange system did not allow the cancellation because their technology was so outdated. The order stood. Desperate to cover the short position they had accidentally created, Mizuho began buying back the shares at any price. They had to close the hole they had dug. The price skyrocketed. Kotegawa sold. He dumped his share into the frantic buying pressure of the very bank that had caused the crash. By the end of the day, Kotegawa had netted a profit of 2.2 billion yen, around $20 million. He did this in less than 10 minutes. The incident became known as the JCOM shock. It cost Mizuho Securities roughly 40 billion yen, and the head of the Tokyo Stock Exchange resigned. Kotegawa became the face of the incident. The media dubbed him JCOM Man. He was 27 years old. He had made more money in 10 minutes than the average Japanese worker earns in 10 lifetimes. When asked about it, he simply said he was lucky and that anyone could have done what he did. I think this is false humility. Thousands of professionals saw the same screens. Only Kotegawa acted with the size and speed. He had prepared his mind for years to recognize anomalies, and when the biggest anomaly in history happened, he did not hesitate. Part 5. The Curse of Scale. By 2008, Kotegawa's assets had ballooned to over 21 billion yen, or around $200 million. He was one of the richest people in Japan, and he was still under 30. However, success brings its own form of problems. When you have 100 million yen, you are a speedboat. You can enter and exit trades instantly. When you have 20 billion yen, you are an oil tanker. Kotegawa now traded with so much money he started to move the market itself. If he tried to buy a small company stock, his buying pressure would drive the price up, destroying his entry point. And if he tried to sell, he would crash the stock. He was now forced to trade only the biggest companies on the stock market. SoftBank, Toyota, Nintendo, and the mega banks. It became harder and harder for him to increase his wealth. What's so funny about his trading strategy is that he had zero interest in the actual companies. In a rare TV interview, he admitted that he had no clue what the companies he traded were actually doing, nor did he care about their earnings guidance. His only reality was the line on the chart. Part 6. The Lifestyle of a Monk. Most billionaire biographies are catalogs of excess. Yachts, vineyards, and private jets. But Kotegawa's list is truly blank. Okay, he had exactly one indulgence. He had bought a 400 million yen condo in the center of Tokyo. Yet, the few television crews that were allowed in around 2006 reported that the apartment was practically empty. There was no art on the walls, no designer furniture, just the trading station with its multiple monitors. Allegedly though, he did buy his parents a Toyota Crown Majesta, the ultimate symbol of conservative Japanese success. But he himself didn't drive. He didn't even have a driver's license. He always took his bicycle when he needed to go somewhere. His biggest splurge, famously, was buying 2 Nintendo Wii. And when it comes to his diet, it consists almost exclusively of instant noodles and convenience store nigiri. He claims that eating large meals makes him sleepy, which slows down his reaction time. He also avoids caffeine because it makes him jittery. He views money as a score in a video game. Thinking about what money can buy invites emotions, and to Kotegawa, emotion is the enemy of trading. Part 7. The Lehman Crisis. The year 2008 was a test of fire for everyone, and Kotegawa was not immune. In September 2008, Kotegawa made a rare mistake. He bet on the survival of Lehman Brothers. He bought the stock assuming that the US government would bail it out as they have done with Bear Stearns. As we know now, they didn't. Lehman Brothers filed for bankruptcy, and Kotegawa lost approximately 700 million yen. In a rare display of emotion, he admitted to punching his computer monitors. He broke 2 of them. It is the only recorded instance of him losing his temper. But then, in October 2008, right at the heart of the financial crisis, Kotegawa made a move that shocked the market. He paid cash, approximately 9 billion yen, for a commercial building in Akihabara. The building, named Chomp Chomp Akihabara, was a 6-story hive of maid cafes and anime shops. As the real estate market was collapsing, cash was king. Kotegawa, that had piles of cash, finally used some to buy a distressed asset in Akihabara, the holy land of otaku culture. As a fellow otaku himself, he knew that the building was undervalued. He also knew that he couldn't day trade 20 billion yen forever, so he swapped volatility for rent. For 10 years, he earned a massive yield that required exactly 0 mouse clicks. By 2018, he sold the building for 12 billion yen, capturing a 30% gain on top of the rent. Part 8. Where is he now? Since the sale of the Akihabara building, Kotegawa has become a ghost. There are rumors. Some say he fled to Singapore to escape taxes. Others claim he shifted to private equity. But the rumors contradict his personality and his deep attachment to Japan. The reality is likely much simpler. As his friend and rival CIS once said, he doesn't trade for money, he trades because it's the only thing he knows how to do. Yes, he might have disappeared, but every time the market crashes, every time there is panic, every time the charts turn red and the world is screaming "sell," I know he is there.